They say the next financial crisis won't start with crowds outside banks. It won't start with shouting, panic, or lines stretching around city blocks like in 1933. No, the next collapse will begin quietly, invisibly, with your money leaving the system long before anyone realizes what's happening. And in 2025, that quiet collapse has already begun. A bank run no one saw, no one heard. And almost no one is talking about, because the most dangerous bank run is the one where no one has to physically run anymore. Today, I'm going to take you through the silent bank run of 2025, how it started, who triggered it, why governments are terrified to acknowledge it, and what it means for your money in the next 5 years. Stay with me, because the most surprising part is this. The warning signs didn't come from banks. They came from us. Before we dive into 2025, you need to understand what changed. For decades, banking depended on one assumption. Most people keep their money inside the system. That single assumption kept banks afloat, but the 2020s quietly shattered it. Fintech made moving money instant. Stablecoins offered yield banks couldn't match. Treasury apps allowed people to bypass banks completely. New regulations pressured banks to hold more long-term securities. Meanwhile, trust in the banking system hit a 40-year low. These changes created a fragile structure, stable enough to look strong, but brittle enough to collapse the moment confidence slipped. By early 2025, a series of small events barely mentioned in mainstream media began lining up like dominoes. A weak earnings report, a surprising downgrade, a liquidity ratio that looked off. Individually, none of them seemed dangerous, but together, they created the conditions for the most silent bank run in modern history. It began with a mid-sized regional bank, let us call it Bank A, reporting temporary liquidity stress, nothing major, just a footnote. But sophisticated depositors read something else. Bank A was holding too many long-term bonds, still underwater from the rapid rate hikes of 2022 to 2023. The moment markets sensed vulnerability, money quietly started leaving. Not millions, billions. Overnight, no lines outside branches, no viral videos, just digital transfers draining liquidity faster than any system could handle. And social media didn't catch it because these weren't retail withdrawals. They were corporate, institutional, invisible. And once those transfers began, the psychological shift started. If one bank was weak, others might be too. From January to March 2025, pressure built. Bank A's outflows triggered a chain reaction. Bank B, which had exposure to Bank A, saw rising funding costs. Bank C failed a liquidity stress test. Bank D warned it might restructure its assets. Still, the public heard almost nothing. Regulators stepped in early, naming everything routine technical issues. But behind the scenes, something unprecedented was happening. For the first time, more than 20 regional banks saw major deposit outflows in the same week, with zero news coverage. Why? Because the withdrawals weren't going to other banks, they were leaving the banking system altogether. Money was flowing into Treasury money market funds, stablecoins, corporate bond ETFs, tokenized T-bills, and direct Federal Reserve programs. The banking system wasn't losing to competitors, it was losing to alternatives, and the silent run accelerated. Then came the week of April 14, 2025, the breaking point. A small Federal Reserve lending program suddenly doubled in size, meaning banks were secretly borrowing heavily. And a leaked memo revealed 3 banks were within 72 hours of failing liquidity coverage ratios. When that memo hit financial Twitter, institutional depositors didn't panic. They acted. Hundreds of billions left the banking system in under 48 hours. Algorithms detected risk, Treasury departments executed moves, and money vanished. Still, the public had no idea. For the first time ever, a bank run happened faster than the news cycle. Regulators intervened, flooded liquidity, and announced everything was stable, but privately. Insiders admitted, we avoided collapse only because no one realized how close we were. The silent run didn't collapse the system, but it transformed it. Deposit levels hit a 50-year low. Banks quietly raised fees. Small business lending tightened dramatically. Real estate markets cooled because regional banks handle most commercial real estate lending. Governments introduced new confidence measures, but these weren't about confidence, they were about slowing withdrawal velocity. Meanwhile, digital alternatives exploded. Stablecoin volume surged. Tokenized treasury markets hit new highs. Institutions began bypassing banks entirely. The silent run didn't end banking. It exposed that the system had already changed. Regulators attempted fixes, higher liquidity requirements, new stress tests, short-term lending facilities, stabilization rules, but none addressed the real problem. Because the real problem wasn't liquidity, it was trust. And once trust leaves the system, no policy can bring it back. People didn't stop trusting individual banks, they stopped trusting the concept of banks. Why keep savings in a 0.5% account when you can earn 4 or 5% in tokenized T-bills? Why rely on slow wire transfers when stablecoins move money instantly? Why depend on banks when government apps allow direct treasury purchases? What happened in 2025 wasn't a crisis, it was a transition, and the pattern is repeating. 2008, mortgage assets collapse. 2020, liquidity evaporates in days. 2023, Silicon Valley Bank collapses in 48 hours. The first digital bank run. 2025, the first system-wide silent run, where money leaves without anyone noticing. Every financial crisis is happening faster, quieter, and digitally. 3 numbers prove it. $800 billion exited U.S. banks in the last 12 months. Only 45% of U.S. household assets remain in traditional deposits, a multi-decade low. And 7 of the 10 fastest-growing asset classes in 2025 exist outside banks. The silent run isn't theoretical. It's measurable. It's happening. And soon, it will be impossible to ignore. So here are 3 takeaways. Takeaway number 1. The next financial crisis won't look like the last one. No crowds, no panic. Just quiet, fast outflows. Takeaway number 2. Banking is no longer the default. Consumers and institutions have real alternatives. Takeaway number 3. This isn't temporary. It's the beginning of a structural shift. And here's the final warning. If you think the system can't change overnight, ask the people who found out in April 2025 that their banks had been borrowing billions just to survive the week. The question isn't, will there be another silent run? The real question is, what happens when the next one is too big to quietly fix? If you want to understand these shifts before they become headlines, make sure you subscribe. We break down the hidden forces shaping money, power, and the global economy. Stay curious, stay prepared, and I'll see you in the next video.